corporations kind of stepped up and said, we need some innovation to happen here, right? We need to find all of the startup companies that are not necessarily in our local neighborhoods, but where's the innovation happening all over the world or all over the country? And can we invest in venture capital funds and build a portfolio that would really expose us to those things that are relevant to us? Our portfolio today has 230 plus startup companies, and it's still growing. We kind of frame it as an outsourced innovation arm. I mean, that's really what we are. We're a look-through, right? How we pick managers, it's like if they're building a firm, not just one fund, if they're going to be around for quite some time, if they're trying to do something in their space based on a thesis that makes sense to us, we will give them the time of day.
Hey everyone, this is Prashant and I'll be your host for the VC10X podcast, and today we have Grady Buchanan with us. Grady is the co-founder and managing director at NVNG, a fund of funds with corporations as limited partners investing into venture capital funds. Before launching NVNG, Grady worked with the Wisconsin Alumni Research Foundation's $3 billion investment portfolio. In this episode, we talk about the investment thesis at NVNG. Why do corporations invest into NVNG fund of funds? What's the strategic significance of having corporations as LPs? How does it help the portfolio companies of the portfolio funds? Key things they look for in fund managers. Advice for GPs raising in a difficult fundraising environment. How they generate DPI in the fund of funds model. Their approach to portfolio construction, and lots more. So without wasting any time, let's dive straight in.
This episode is sponsored by my own podcasting agency called LP10X, where I help venture capitalists, asset managers, allocators, and family offices in starting their own podcast and building a strong brand. LP10X is designed in a way to work well with the busy schedule of investors, where we handle every aspect of podcast production so you can focus on investing. If you're looking to build a strong investor brand, starting a podcast should be right up your priority list. It's the only form of marketing where you can showcase your strong network, in other words, access to limited partners and founders, and grow that network further. And contrary to what most people hear, it's still very early to start a podcast. There are at least 10x more newsletters and 1000x more blogs than there are podcasts in this world. You can learn more about our podcasting services at podcast10x.com. I'll make sure to add the link in the description below. Enjoy this episode. Hey Grady, so good to have you on the VC10X podcast. How are you doing?
Prashant, I'm doing well. Thanks for having me.
Yeah, it's a pleasure having you on. To start things off, can we first have your story and how you got into investing?
Absolutely. So my story kind of starts when I graduated school. It was either going to be the investment route or something else. I actually chose a sales route right away because it was something in treasury management. So it sounds super sexy, I know, right? Selling treasury management products. But it helped me learn dollar in to a dollar out, learn more about a business, learn more about how some of our larger corporations here in Wisconsin were working, because that was the market I was in. And then I quickly shifted after that to the investment side. And that's where I got my exposure down at, I was at Northern Trust at the time, and got exposure to a lot of institutional investors, a lot of clients down at Northern Trust, one of which happened to be the Wisconsin Alumni Research Foundation. So where I went to school, and I guess any school nowadays has a tech transfer office. So what tech transfer does is a conversation for a different day, but uniquely Madison's campus and the tech transfer office there has an endowment fund. And so they had a pretty well-built team, heavily awarded on innovation, certain things that they were doing. It was a pretty robust client, if you will, for the size of assets that they didn't have compared to some of the bigger funds. And so it was attractive to me as to what they were doing, interesting to learn about how they were allocating dollars. And then I got very fortunate, I'll call it serendipity. They needed an analyst. And so the person that I was working with there hinted at it a little bit, ended up going up to interview with my now partner in Carrie, and she was the chief investment officer at the time. And I think they saw enough, which I was very fortunate. They saw enough to let me onto the team, kind of doing performance holistically for the plan. Started on the hedge fund side to help our hedge fund professional and fund manager on that side, and then shifted more toward the venture and private equity side, which is obviously the seat that I sit in now with NVNG. But yeah, it was probably a pretty normal route, if you will, but got very lucky along the way in terms of job openings and the opportunities that were there.
Great story there. And let's talk about NVNG. Is that how you say it? NVNG?
It is not. So it's an acronym because we like our acronyms, right? So the Wisconsin Alumni Research Foundation, WARF, and NVNG stands for Nothing Ventured, Nothing Gained, and the IA
Okay.
is Investment Advisors, right? So Nothing Ventured,
Okay.
Nothing Gained. Yeah. So it's that little aha moment. It's like, oh, you either like the name or you don't, right? But so NVNG, shorter, a little bit easier to kind of say. But NVNG was a kind of a culmination, and it kind of came about through when we ended up leaving the WARF investment team. My partner and I, so again, Carrie Tomey was the chief investment officer of WARF for about 10, 12 years. And before that, she had spent time in private markets at our state pension plan, which is very decent in private markets. And so in looking at her when I had left as well, it's like, well, I'll follow you. Like, what is it that you want to do? And obviously she had opportunities at other larger pensions, endowments. And when you look at the models that we have, and I also knew that she was going to be in Madison, and I had intentions to stay in Milwaukee. So both in Wisconsin. And when you looked at other neighboring states and what they were actually doing, that was very kind of somewhat of a catalyst for them on the venture capital side specifically, which is, again, the seat that I sat in where I wanted to stay. They had these fund-to-fund programs. And when you think about what we do as endowment portfolio managers on the venture capital side, it's they're kind of fund-to-funds, right? So we had 50 some relationships on the private equity bucket that WARF had, and managing a portfolio of a pretty well-built venture capital, buyout, anything in private equity book. Can we do the same thing for other unique investors in Wisconsin? And you look across Lake Michigan, we have a really, really talented program over in Renaissance Venture Capital that started 12 years-ish before we did, under the guise of corporations. So corporations kind of stepped up and said, we need some innovation to happen here, right? We need to find all of the startup companies that are not necessarily in our local neighborhoods, but where's the innovation happening all over the world or all over the country? And can we invest in venture capital funds and build a portfolio that would really expose us to those things that are relevant to us here in Michigan? Here in Cincinnati has one in Centrifuge. And then there's one down in Houston. And these have been popping up all over the country over the past 10-ish years. And Wisconsin didn't have one, right? So at WARF, that was our one investor, the university, right? Make returns, give the gift, typical endowment type spending. And then when it came to it, it's like, can we open this up and really draw on a unique investor base here in Wisconsin for Wisconsin, under the same strategies that some of these other models had, where one thing we know is the venture capital universe. We know those funds pretty well. How do we relate those to Wisconsin? So go out and get a bunch of corporations to say yes to this, take a chance, see venture capital for what it is. Many of them had innovation departments or either a corporate venture office or not. And then, will you invest in this? Can we go out and find 20 managers that make sense for the state of Wisconsin? They might not all be here. They might not even be investing in the state of Wisconsin, but are they doing industry aligned things? Are they doing things that can kind of cross functionally work within your organization? And do you want to see these new technologies and software and hardware tools that are out there that relate to you guys? And so that was the idea. And then we got pretty fortunate to get a few large corporations, the state pension plan, and a few others to follow on there, and managed to raise our first fund there. And it's a 2021 vintage, but took a good while to raise that, took a good while to kind of educate and put the awareness out there. But again, it's a model that's been built in other neighboring states, fortunately, and Wisconsin, we felt, deserved this type of exposure, and just could be, and maybe NVNG could be one little catalyst that would help the startup ecosystem locally, the venture capital ecosystem throughout the Midwest. And so that's more or less how NVNG started and where we're at. But yeah, long-winded way of saying, Prashant, nothing ventured, nothing gained, investment advisors. That's that NVNG IA.
Yeah. Yeah, incredible. And so having corporations as LPs, so you have also worked on the institutional LP side along with your partner as well, and now raising a fund of funds and having LPs. So what was the thought at the outset? You were thinking that, okay, maybe we could also target institutional LPs because you obviously have worked at those places. You must have connections there. That could have been a target also. or were you from the outset targeting corporations that, okay, we want to raise from them, and then try to bring up the local ecosystem?
Correct, right. So it's more labeled strategic, right? I mean, you can kind of hear our backgrounds. We're rooted in returns, right? We know how to underwrite the venture funds. These are not handout dollars, right? Like these are still rooted in returns. We need to build a portfolio, and it's something that we felt comfortable doing, having that past experience of a portfolio of 20 venture capital managers. But again, they better be investing based on merit. If they can invest in Wisconsin, again, it's based on merit. And what we could do in large part is share what the startup ecosystem looks like here. We could bring the venture capital managers here because they all want to learn what our largest corporations are doing. Because at the end of the day, those are acquirers, buyers, customers of some of these startup companies, and maybe these are technologies that they're not going to see without us. So again, that was the idea. But it doesn't mean it's not rooted in return. So to your point, while it's labeled strategic for a lot of the corporations, because we do invest in managers that are very specifically aligned with a lot of what our corporations are focused on, either problem statements or just large industry sectors that are a little bit unique to what I would call the coast is doing, just because you can think about the Midwest and what we're good at. But for large institutional investors that don't necessarily need the strategic side of it, if you think about how we could generate returns, and again, it was all an idea, right, Prashant, whether we didn't know, but with corporations, if you could actually get the startup companies within the portfolio, our portfolio today has 230 plus startup companies, and it's still growing, as you know, fund to funds. But how do we get these companies, whether they're doing really well, whether they're doing poorly, whether they got some sort of use case, how do we get them speaking to the corporations earlier? Because if you can speak to a corporation earlier, give them the startup, the founders, the time of day, maybe they don't have to wait and build something in a silo. Maybe they can pivot. Maybe they can get an early customer, pilot programs, and really open up that funnel of their thinking rather than spending 2 years, then go to market and hoping, right? And so if you think about it that way from the earlier stage or even the later stage, because a lot of these companies in the portfolio are later stage and more corporate ready, if you will, but how do you get them further along faster or to a no faster, right? Like this isn't something we want. And so from a return perspective, I think it truly helps the venture capital managers because we can actually access corporations that they'd like to sell into with their portfolio companies one day. But at the end of the day, it's if the corporations they're already invested in it all, right? So for them, they get to help and lend support. And for the institutional investors, and the corporate investors, that should generate higher returns. It should be some sort of value add to the portfolio, which is why we use the strategic side of things.
Absolutely. And at both these places, the institutional investors as well as corporations, for institutional investors, of course, they have their internal team that is, looking to allocate into venture capital asset class or maybe private equity. They have a team there in place for that. And for corporations also, some of them have that program already in place, people, in those positions to do those jobs. So when you're going and pitching them, does that to them feel like, okay, they're outsourcing a part of their job that they are meant to do themselves, or they're reluctant to do that, okay, I will do that myself. Why do I need you? Why do I pay you fees? Right. So would love your views on that.
No, it's a good point. We have job security. People get sensitive, right? If you have a corporation and we know our fund is not necessarily for everyone. Because some corporations do this really well. They do it in a vacuum. They do it very siloed for reasons that would make sense. So you think about healthcare, right? They might not want to share everything that they're doing, and the data side gets very private. But even larger manufacturers that don't necessarily want to share kind of the next widget that's coming out or kind of the schematics around their next kind of tools. And that's fine. Like they might have very well built teams. Our goal is to just be a helping hand if we can. We'll take every meeting. We'll make sure that we'll help the startup ecosystem here. And we will talk to the corporations, whether or not they're investors in the fund, because again, it all helps those that are in the fund and the portfolio companies that are aligned with them. But it's a good question. We kind of frame it as an outsourced innovation arm. I mean, that's really what we are. We're a look through, right? These are venture backed companies, so that does mean something, right? Not everybody needs venture capital funding. Not even all of our corporations back in the day. We have some of the biggest ones in the world here, just in Wisconsin. They were not venture backed, right? Like it's not something that their families necessarily had to do. But they all took risk as entrepreneurs. They had an ecosystem behind them. And for us, it's can we generate returns and use them as a value add? One, and then to your point is if you're sensitive around it, that's completely fine. We're not here to, take your roles. If anything, it's a conduit and it's supposed to help you. It's kind of like if people came to me when I was in the analyst job and it's like, hey, we have a better tool to help you do performance, and maybe your spreadsheet, Grady, could break every now and then. It's like I'd probably walk into Carrie's office and say, let's see what this costs and let's see if this makes sense. Not because it would put me out of a job, but because I could probably spend my time and resources elsewhere. And that's how she built the team. That's how we think about things. But we do understand it. People get sensitive for certain reasons. And again, we tell people about the fund. It's not necessarily for everyone. And if you can do it yourself, great. That's awesome. We don't have any qualms about that. We wish more and more people did that, actually. But we see the fund of funds as something you're probably not going to get yourself, right? 200 plus companies. Portfolio at the end of the day should have 400 plus companies, right? So if there are cross-functional needs, maybe you're really good at your specific sector. But what about the HR department? What about the marketing department? Are there certain tools that they're looking at that they could be useful, that our fund could be useful for in some of these portfolio managers? So again, that's why we think the fund to fund with funds that speak very specific languages, you get this kind of balance and look through on all of it. But your point is well taken. There is pushback. Oh, this is my job. And that's completely fine, right? If you have a team to do that, we hope that they still chat with us. We hope that they still have a look through into what we're doing. Because again, it's not a mutually exclusive effort for us. We're rising tides people here, specifically locally. So, but you are right. Like there are some around here without naming names. It's like, well, we can do this. This is our job. This is kind of like, we don't need to expose everything we're doing. And we can find this ourselves. It's like, great. Like, we'll be here. Let us know. But yeah.
Yeah, absolutely. I appreciate the transparency on that front. And so there is great value add on the corporations front, great. They can find innovations early on, a lot of tools they can get their hands on. And even on the startups or the portfolio company side, a lot of value that can be added if they get to work with these corporations or get them as customers. But as a fund of fund, you are 2 layers separated from portfolio companies. There is a VC involved, and then there are portfolio companies. How frequently or how often does that value add actually come to fruition, that the portfolio companies actually coming to the fund of fund, that is an LP in a VC fund that has backed them, and asking, okay, can you introduce me to some customers, or maybe get me in touch with someone who can help me with this? How often does that really happen?
We hope a lot more in the future, Prashant. So we're still slow moving. I mean, we were a 2-person firm up until a couple of months ago, and we made the decision to hire a platform person specifically for this. So the kind of that, to your point, there's a lot of notes here, like who's going to be that human router that can actually do this. So corporations, they have day jobs, right? Even innovation managers, even the people we work with in the C-suites, it's like, this is not necessarily the first priority to hear from us. It's like, hey, there's this cool startup that just raised $1 million. You guys should talk to them. That's not really the highest on their list, unless they have the right people that are sitting there and waiting for those. But for most of our investors, they don't necessarily have that. And so for us, we need to get very pointed here in the future, and with the current fund, now that we have all of these companies, we need to get very pointed. And so we hired a person. She sits in Chicago, and can she be the one to actually assess with the limited partners that we have, what are their actual needs? What's the cadence in which they want to be relayed this information? And what kind of startups do they actually want to see? And right. And so the question would be like, oh, we should know this, right? But people change, corporations change, administrations change, right? New initiatives come out. And so right now it had been, let's spend a couple of years investing in the right fund managers that have an interest in what we're doing and have an interest in the corporate ecosystem in which we support. And now that we have the companies, to your point, it's some of them have asked. So to your point, I don't have, and I won't name names, but certain companies within the portfolio, a couple of our investors have actually brought them up to Wisconsin so they can kind of tour them around. We do very specific and corporate aligned events, and we've done 2 of those. We've just done them annually to really open up the corporate ecosystem here and bring in a bunch of venture capital fund managers, a lot of which, of course, are in our portfolio. And in the second year of events, we brought their portfolio companies here as well in ways where we can put them up on stage, talk about how they're partnering with corporations. Oh, and not for nothing, they're in your portfolio. So admittedly, we're going to do a better job and with our new hire, figuring out the use cases and what these groups actually need and want, rather than guessing, right? It's like you can guess on the manufacturing side and the healthcare side, but they can get very pointed, some of them. And do you want to be followed up with weekly? Do you want to be followed up with monthly? To answer your question, though, it is still going to be us kind of navigating that, right? It would be great if the startup companies had access to just the corporations. I don't necessarily know if the corporations want every startup to have access to them, right? And so it's kind of like you don't find a lot of emails on venture capital websites, right? And so because every startup in the world would know that. And so for corporations, it could be very similar. So to your point, we sit a couple layers in between, but the idea that we need to connect them and get some of these companies here. A lot of these companies have been growing for 4 or 5 years now, and they're corporate ready, right? And so how do we bring them up here? A couple of our limited partners are very strong at this, and they're very helpful. And it's like, oh, we need to bring them up here and introduce them to this corporation that we're not even related to in any way, but they're opening up the portfolio. They're trying to get customers for these companies. And so I expect that to happen a lot more, hopefully. And it's something we're going to get better at. But as two people, we needed to raise that first fund, start investing in the managers, and now we get to work and actually make those kind of synergies between the corporates and the startups happen.
Absolutely, yeah, that's amazing. And yeah, I totally agree. I think a more proactive approach from you will be required as a fund of funds right now from both sides, I guess, because even corporations, if you have a portfolio of 200 plus companies, it's hard to keep track of them. How many are they, and in which sectors they operate? Can I use some of them? Can I benefit from some of them? Are there synergies? It's hard for them to explore. But I think as a fund of funds, you can make those synergies happen. You can connect. Okay, there's a startup that you might be interested in. If in HR you're facing issues, you need a software. This is one software that is in your portfolio that you can potentially check out. So I think that is where a lot of value that can be realized there just by being more proactive. So yeah, I love that you recognize that. Awesome. And now coming to the investing side and backing fund managers, what are the key things you look for in them, and how do you back them?
So for us specifically, it's not totally dissimilar from where we were at, right? So we had, like I talked about, we had the one investor in the university, venture capital. We still need to make hard returns, right? That is how we're benchmarked. That is how our jobs are working. And that's why you hire investment professionals in these roles. But it wasn't strictly return, right? I think that still comes first at NVNG. These venture capital funds have to be institutional quality or on their path to do that. What does that mean? It's probably they're talking to institutional investors, endowments, foundations, large pensions, and they have some of those stickier capital providers that have done venture capital before. So there's some trust in that underwriting process where kind of similar to how we operated. But again, when we were at WARF, how do you get some of these funds on campus, right? Like there's a lot of research dollars that go to Madison's campus, not unlike others across the Midwest. And can you get some of these venture capital funds here to talk to the researchers, talk to the startup companies that might be spinning out? They're still going to invest how they invest, right? Like if they're in Boston, they're going to invest in some Boston companies. They're going to invest based on merit. And again, they have investors that their fiduciary responsibility is to generate returns. So no hand forcing here in any way. No like, oh, you're going to come here and do this investment in our state if we give you money. That is not how we operate. It's not how NVNG operates in its current fund. So the fund managers in which we pick, most of them will speak a very specific language. So how we fill our buckets are, if you think about industries across the Midwest, we touch almost all of them, right? And so there are fund managers out there that have popped up in the last 5-ish years. And they, like I say, they speak one specific language. So they're very good at manufacturing technology, or they're very good at software wrapped in hardware in some of the deeper tech areas, or supply chain. Or specific in therapeutics and diagnostics, and maybe one's just specific in medical device. If we could build a portfolio of 20, 25 managers where at least maybe a corporation has no interest in healthcare, but they have a question about something related to healthcare, they'll have people there to speak with. They'll have partners at these firms that they can speak with. And for us, it was most important to open up the network here for Wisconsin and get a handful of venture capital managers that were across industry. But again, in a fund of funds, they better be generating returns, and that's how we underwrite them. And so when you pick the manufacturing sector to be specific, there aren't really that many managers specific to our size, right? We were a smaller fund one that we can necessarily try to get into, or that would move needles for us, or that were actually very familiar with the Midwest ecosystem and what they wanted to do in there. And maybe they'd come up to Wisconsin every now and then. That's great. But they're very good at what they do, right? And they're probably backed by investors that look like other Wisconsin corporations in the space, or other families that have built within these industries. And that's, again, manufacturing, supply chain. It could be aerospace and defense, right? We have one that's doing that. So if you have questions, I kind of know who to go to there. Or if our LPs have questions, oh yeah, you should go talk to them. But again, how we pick managers, it's like institutional quality. And it doesn't mean we haven't done fund ones or spin outs or even true emerging managers. But if they're building a firm, not just one fund, if they're going to be around for quite some time, if they're trying to do something in their space based on a thesis that makes sense to us, we will give them the time of day, right? Like and if they'll all say the right things, right? Like, oh, the Midwest is great, Wisconsin's going to be great. But when you start to get into the underwriting and what they actually do, and if the portfolio companies are relevant to our investor base, then those are the ones we kind of start to hone in on.
Absolutely. Yeah, that's a very interesting point you touched on, that they're building a firm and not just a fund, right? How do you tell that? Is it just from their mindset? How are they thinking about it? Are they, already in conversations with the institutional LPs that are not going to be investing in this fund, most probably, but they're still thinking about it, that, okay, in future, I'm nurturing these relationships so that in future, when I'm going to raise fund 2, fund 3, I can get their deployment, right? So is that how you judge, or are there any other ways to do that?
Well, you can literally ask them, right? And we can see some of them. Oh, I don't. All of them will say yes, right? It's like the institutional quality path and the diligence that we need to go through because of some of who our limited partners are and the diligence that they require. You just have to be able to do that kind of stuff. And it's not. And again, it's not for every venture capital manager. There's plenty of VC managers that are smaller in size that don't really have an interest in the institutional side of things. They can spin out of a family, go invest in their own deals, and that's a great business, right? And it's actually, we see a lot of them on the cap tables that are relevant to our venture funds themselves. But to answer your question, some of the tougher ones for us could be some of those family spinouts, some of those ones that are backed by either corporations, right? It's like, oh, is that corporation just setting you guys up, or are they going to be there in the future? Are they going to drop out in fund 2? And so when we look at that, it's basically, the question comes down to is, who are the limited partners that they're targeting? Because if they're targeting venture capital allocators, pensions, endowments, even larger family offices that have been in the asset class for a while, they understand that it's not great to invest in one fund and then leave it and then try to get into the third fund. Like, very few of our managers are focused on that. Most of our managers are really targeting some of those stickier institutional providers, heavy diligence providers that can actually help them get to that next fund. And true partnerships, right? Partnerships that are going to provide them strategic use cases, but also they'll deliver returns. It's their duty to do so. But and that's why we like NVNG in that we need to be partners to our venture funds. There's plenty of capital out there. They can go get it from elsewhere, but if they want it from us, it's we need to provide our value as well. And so when we look at our fund managers that are saying those kind of things, it's not posturing. We're not going to come to the Midwest, and we're not. It's just like we're not a fund for everybody, not every fund is right for us. And so I think long-winded way of saying, who are the limited partners that you're speaking with? And you might be too small. Limited partners might not do a fund that's of a smaller size, but it doesn't mean you won't get there one day. It doesn't mean that you're not trying to structure your practice in ways that would make sense for these larger and stickier ones. Because we have small funds in the portfolio that don't necessarily have the highest level of institutional quality investors. Maybe they're new to the venture capital asset class. That's why we do a lot of reference checks. That's why we do a lot of conversations with their limited partner base as to, and to answer your question, it's ask those investors. and say, hey, are you underwriting for one fund, or do you really think that they're going to grow, and are you going to be around for fund 2, fund 3? And is this an asset class that's important to you? And when those answers come back positively, it provides that, interest for us as well.
Yeah, absolutely. Yeah, I think that's a great approach. And from the corporate venture capitalists that I have interviewed on the podcast, like typical corporate venture capital firms, right? Most of them are focused on the sector that they're already operating in, right? So when you are going to these corporations, pitching them to be an LP in your fund of funds that is kind of sector agnostic, are they telling you that no, we just want to focus on the sector that we are already operating in, or we want at least these many percentage in your fund to go to the sector that we are focused in? Is that what you get?
Sometimes. So I would say that we've only done this with one fund, right? So still exploring, still assessing the market, talking to new corporations. Most of them do have that like me mentality, right? Where it's like, I do beverages, this is what I need, or I do manufacturing in this specific sector, this is all I need. I think you don't know what you don't know, right? And we're guilty of that as well. But when you look at larger organizations around here, they do have a lot of different departments, a lot of different use cases as to what makes sense for them. But they're right to focus on their core, right? Like we're not going to tell them what not to focus on, what to focus on. Our job is to teach them that, and there are venture capital managers in our portfolio. We're happy to introduce you to them. If you just want to do a one-off fund that's very specific in your sector, I think we can help you find one that makes the most sense. We're just one investor, but here are our thoughts. Like maybe go into them. Again, not a mutually exclusive organization by any means. There's plenty of corporations across the Midwest. If they're doing venture capital or they only have specific problem statements, then maybe they are better off going into 1, 2, or 3 funds that are corely aligned with them. Most of them, Prashant, though, are not necessarily only doing that for returns. So if it doesn't matter to them strictly on the return profile, because they can see returns in multiple ways. The IRR is one thing, the multiple is one thing, but the returns for them come in those underlying companies. Maybe it's the value add that the portfolio managers give because they do quarterly events and they teach them about, what's next in this industry. But if they're investing in things that are very relevant to them, that's maybe a better route for them to go. But if you like the diversification approach, which I think we could talk like fund to funds returns and things like that, and you like the idea of having this ability to kind of look through multiple industries, multiple sectors, then I think the fund-to-fund model makes a lot of sense. Or if you're not doing this yourselves, think about this. A lot of corporations only have you or me or one person in this role, and they're tasked with a lot. And then they can build out a team and they can go do private deals. But are you going to invest in 20 venture capital managers? Are you going to manage this professionally? And that becomes a daunting challenge, right? Where, again, that comes back to us, platform, making sure that we help curate this stuff so it is not overwhelming. But we do believe that diversification matters, especially on the investment-only front. And we also believe that the amount of portfolio companies that we have, there should be some hits cross-functionally if you have an interest in that. But again, I go back to, it's like some corporates do just one-off fund managers, and a lot of fund managers, I mean, you can ask them, some corporates are really good at this. Some corporates are really cumbersome. Like some corporates get in the way. And when I say get in the way, it's not necessarily only their fault, but that me mentality, you're going to do things the way that I want to. There's other investors in that fund, right? And so for us, when we come across those funds, which we do, we have to talk to these corporations and say, well, are you guys kind of like, are you the guiding light here? Because not necessarily, your interests aren't necessarily aligned with our interests. We need this fund to return capital. And if they're only doing things because you're telling them this is our use case and we don't really care about the returns, we just intend to use this kind of program, that's misaligned with some of the other investors that are in the fund. So fund managers have to think about that. And when I say that, it's often hard for fund managers to take those corporate dollars if they are brand new to the asset class, or if they think they're going to be very, chatty, right? But at the end of the day, it's like hopefully those corporates are very helpful to those fund managers. But yeah, it's a balance you have to strike. But our thoughts and the way we built it is diversification is important. There are different use cases inside of every organization, certainly of these sizes around here, that it's not just what you would label them as.
Yeah, absolutely. I think great views on that. You covered multiple facets of that question, which is great. And now let's talk about DPI, right? And in the fund of funds model, we have seen that you're investing in VC funds. So VC funds have a 10-year cycle. So naturally, fund of funds would have a somewhat longer cycle than that, 11, 12 years at least. And now we are seeing that VC funds are also not closing within the 10-year time frame. A lot of them are stretching beyond that 11, 20, 12 years. So in that case, how are you thinking about generating DPI in the fund of fund?
Yes, so we actually have opportunities in that space, right? Because we can invest in fund managers that are across the continuum of stage, right? We don't have to do only emerging managers. Vintage years might look similarly, but when you invest in a true emerging manager that has 40 million bucks that's going to do early stage stuff, we do expect that to take longer. When you do things that we do in the hardware space, those naturally take longer, right? A little bit more capital intensive. And some of our portfolio could be labeled science projects, right? Where they're hard material sciences or they're drug platforms. And it's like, all right, we have really talented managers in that space that have proven returns. But yeah, I think the average, I mean, we said 10 years, I think it's closer to like 14 years, even for some of the bigger ones that are out there. And maybe that's because companies don't go public as much and they can grow at certain scales. But we are looking for funds that are taking those binary bets, right? We're hoping that these companies all do very successful, and they end up doing some pretty good things for our overall portfolio. But to answer your question, the way we try to balance it, timing is important, right? So the way we try to balance this is we put a couple of later stage funds in earlier in the portfolio, mainly because those naturally take less time. And we also did an opportunity fund, which is quasi-public private. So underwriting those returns are a little bit different. Still a venture capital firm, still a 3X net, but I just don't think they're going to be the one that hit the 10 to 20X, right? But what they do is they take money off and then they kind of provide the capital and the liquidity right away. So for us, we actually get to balance the portfolio out in the managers that we choose. But it's still, we're looking for kind of the next generation of early technologies, specific to kind of core Midwest is our model, obviously. But in a fund of funds, we don't have to label ourselves a seed fund of funds. We're not an early stage fund of funds. We invest across that continuum, like I said, and that does help to balance some of the timing. And hopefully exactly what you said, we're only a couple years behind most of the managers in the portfolio. And in early days, what I'll say is we also did a few managers that were pretty far along, right? Like a lot of these had really well built, kind of, you had that see-through lookability. Some had 30 companies out of the 35 they were going to invest into. So yeah, in Fund One, it was important to us to balance that because we understood that distributions, we can't wait 10 years for those. Maybe we can help balance that over the interim while some of those earlier ones start to grow.
Yeah. Absolutely. And I think some recent data came out about how the dollars that are flowing into the venture capital asset class has gone down from previous years. And it is generally a hard time to be raising a fund, right? And you being an LP into VC funds, you must be getting a lot of pitches. What would be your advice to VCs who are fundraising right now? What are the best practices that they can follow, or what are some mistakes that they can avoid to, make this a more efficient process?
Yeah, I think it's a really tough environment because the last 4 years, 5 years, everyone was able to raise a fund and they did it pretty quickly. Not everyone, right? But like some very good fund managers, very good spin outs, new emerging managers across like our market here in the Midwest, especially. And everyone became a GP, right? And that made it naturally very competitive. And if they raised a fund, it might not have been of the size that they wanted. Ours we're guilty of that as well. But you take what you have, you make sure that your investor base is interested in what you're doing so that they can follow your story as well, and that they also know that your intentions are in 3 years we'd like to come back to market, right? Like this is how our process works. I think a lot of venture funds, what I would caution them from doing is deploying too quickly. A lot of them have great deal flow, right? And it's nothing so much against the managers, but they deploy very quickly. And then we've seen some managers come back in a year and a half, 2 years, and ask for more capital because they're constrained, they need more capital, they're going to be out of market. And for larger pensions, endowments that are balancing a larger book of multiple managers, they kind of need that timing cadence. That's important for them. And how they rebalance from the public to private side is very important. And so you can't naturally expect them to invest in you guys after a year. It's like, and I think vintage years are very important in the way that managers should be thinking about that exposure. Deploying it all into 1 year, it's like there's some risk there, even if the managers tell you, it's like, well, these are all different types of companies and they're all different stages maybe. But that's still, it's to me, it's everyone's trying to raise capital because maybe they put themselves out of market. Doesn't mean the companies aren't going to be great within their portfolios, but it does make it naturally hard for investors that need certain vintage year exposures, and they're working on certain timing cadences like I talked about. So end of the day, I mean, to answer your question, I would really try to differentiate myself. So that's on the fundraising side specifically, but differentiate yourself. I mean, every manager comes to us with very similar statistics. Here's where the world's kind of heading. Tell me how you're going to find the outliers. Tell me why the certain geography in which you're investing matters. Tell me the networks that you have, because those are the things that we go pretty in depth on. And when you get in the weeds on, all right, this manager knows everyone. Are they attracting the founders in their space specifically? Do the founders know how to find them? And are there other founders in their universe that are speaking highly of them? And then do they have the downstream capital connections, right? So on our early stage side, it's great that they can find great companies, but if they don't have that exposure to some of the bigger players that are still in existence, again, it's 500,000 is relatively easy to raise as a startup. We like our fund managers that can write those kind of checks, but they better have those connections in the nexus to like the ones that can write the $5 to $10 million checks and actually put them on the map in certain ways that they will need to grow and scale. And so I would come in really pointed whether you've raised a single dollar or you've raised 3 funds. I think it's the same. I think fund managers, you have to attract the founders and you have to have, depending on which stage you're at, but you have to have the co-investors in that syndicate kind of network post you guys that makes it attractive for limited partners just to see that whole flywheel.
Yes, absolutely. And coming to my last main question before we try to wrap this up, and that is about portfolio construction. How do you approach that in the fund of funds? You have a large portfolio of startups, so that's like 200 plus startups in there. What do you have any demarcations for what sectors you want to target and how much of an allocation should each sector get, and also any stage specific allocations that okay, this percentage goes to this stage and we'll diversify as per that, and also maybe a mixed strategy of going into VC funds and then also going direct into outliers, which I've seen some fund of funds follow. So give me an insight into your portfolio construction strategy.
Yeah, these are good questions, Prashant. Some of the questions I was saying, not necessarily for fund one. I mean, obviously, Carrie and I do this. We have an advisory committee that's made up of some of our larger investors that have invested in venture before and understand this. And so when we bring fund managers to them, we won't just bring the fund manager. We'll bring kind of that network of the funds. And so here are the 5 or 6 that we think are really powerful in this space. And not for nothing, we need this kind of exposure because it's important to our LP base. For us, it's that opportunity is not so much boiling the ocean, right? Because when you get very granular into certain sectors, there aren't that many funds that are outperforming in specific sectors. Our job is to kind of find those newer ones, hopefully, that are going to do that. Just because, again, smaller fund writing smaller checks. But we cover, at least for Fund 1, we cover almost every industry that's relevant to our LP base. We cover almost every industry that's relevant specific to Wisconsin, and Wisconsin, Midwest, eerily similar, right, as we sit in here. But no, at the end of the day, we weren't taking heavy conviction bets into certain managers that we thought were going to outperform. Our checks are all relatively consistent on the construction side. And from a timing perspective, we knew that we were going to do 6, 7, 8 funds per year, right? Like if you just, because again, 3.5 year deployment. And so it's important to balance those based on their stage, but it's also important to balance those based on when they're coming out to market and are they the best in the defense tech sector, and do we need one of those? And they might not be raising today, so let's make sure that they're in the pipeline. Let's date them for a couple of years and then put them in. But our goal with, again, Fund One was to really have an answer if a corporation had a question within a sector, right? So most of our corporations, to your original point, it's like they care about themselves, they care about the sectors in which they're in, and they should. But if they did have another question that isn't really aligned with the label of their core business, let's cover that too. And not just to cover it as well, but because we all have LPs that are specific in this industry. So on the construction side, it was important for us to build that network of fund managers, write checks that could move some needles, but really not try to overweight any specific manager, any kind of like, oh, we think they're going to truly outperform all of the other managers in the portfolio. Again, most important, Fund One was build that network and just get the right managers into the portfolio that are specific to the LP base here.
Yeah, absolutely. And now moving to the rapid fire round, wherein I'll ask you 5 quick questions about the investing you're doing, and you have to give 5 quick answers, right? So the first one is, what are the themes and regions you invest in?
Themes and regions, specific core to the Midwest, right? So these are deeper tech industries, companies that might take a little bit longer. It doesn't mean they're not software companies, but specific in manufacturing, supply chain, healthcare, maybe some agriculture type things. But yeah, geography, think core to the Midwest, which is really just kind of sands the coast. It even goes all the way down to Texas, right? In our minds. But yeah, core to the Midwest type big industry.
Got it. So basically, these VC firms that are pitching you, they need to be headquartered in the Midwest and they can be investing across the USA, or is it like they also have to be investing in the Midwest region?
They almost neither. It'd be great if what you said is true, right? Like that would be awesome, right? If we could kind of like, Silicon Valley back in the day, if you could ride your bike to every startup, and that's easy, and it's like you don't have to do anything more than that. Today's virtual world, we know that our fund managers could exist anywhere. It'd be great if and we have a handful of Wisconsin specific managers, and Midwest, Chicago specific managers. But not necessarily if they're doing. We have a decent manufacturing one that's down in Texas for reasons you can probably guess, and they work with some big manufacturers and big builders. But that's where they probably should be, right? It doesn't mean they don't know anything about Wisconsin. They actually have a lot of ties up here, but they can be anywhere. It'd be ideal if they're investing into Wisconsin companies. It'd be ideal if they're investing across the Midwest. We do think that that's where a lot of startups will start to unearth themselves. But at the end of the day, they need to be investing in things that are highly relevant to our investor base. And that, just like our investors around here, just our big corporates, they don't sell just to people in the Midwest. They sell globally, right? And so having that broad reach and exposure, those fund managers could be anywhere. But again, ideally they're here. Ideally, we're able to give capital back to the ecosystems in which we support. Yeah.
Yeah, great. What's the typical LP commitment size?
The checks we're writing in Fund One are between $1 and $2 million. Again, $50 million fund of funds. You think about 20, 25 managers. You could do the math on that, and it isn't to say there aren't some outliers within that portfolio, fewer and larger, but that's pretty consistent with Fund One.
Noted. What stage of funds do you like to back?
We don't have a strong bias towards stage. Again, construction's important for us, as we discussed, kind of having the later stage managers in there a little bit earlier and later, right? But what we're seeing is a lot of early stage technology focused firms, a lot of spin outs, a lot of new emerging managers that are really powerful in this space that we think are going to become the next, Sequoias of the world. And maybe they do become these big production houses in ways, but we like the fund managers that are very corporate aligned, whether or not they have corporate investors or families in that space, but they see one specific kind of area and sector, and they see the growth in it, and their job is to teach us and educate us that that's going to be the real case. But a lot of them come down to Prashant. They're emerging. A lot of them are brand new GPs, and I say brand new. They're on Fund Ones and Fund Twos, but that's what we see a lot of. Our portfolio has a mix of all of the above. Like we have fund sevens in the portfolio, we have fund ones in the portfolio.
Got it. Noted. Where can GPs get in touch in case there is a direct way?
Pretty simply, Grady at NVNGIA.com. Or Carrie at NVNGIA.com. We're pretty easy to find. LinkedIn, I'm pretty responsive, as you know. Any email is easiest for us.
Awesome. Last one, where can our listeners follow you?
On your podcast, obviously. LinkedIn is probably the easiest source for us. We're not too out there in other ways, but yeah, by all means, reach out, LinkedIn, email. Happy to get in touch. Happy to chat virtually or in person anytime.
Awesome. I'll make sure to put those links in the show notes below. Thanks so much for making time for this, Grady. It's been a great conversation. I appreciate the transparency and the insight you have given, going really deep into all the questions that I asked you. Thank you for that, and I wish you happy investing.
You too. Thanks, Prashant.